Welcome back to the deep dive. Today, we're cutting through the noise, really digging into the Q2 financial results for fiscal year 26 for SBI Cards. SBI Card.
Yeah, we've got the regulatory filings, the investor decks from late last year, October 2025.
And our mission really is to piece together what's happening with this major player in the credit card space for you.
Exactly. We want to synthesize those key metrics, figure out where the growth is really firing up, spends, new cards, but also where the pressures are building. Think costs, returns.
Because there's this immediate tension right in the headline numbers. You see total revenue up 13% year on year, hitting 5,136 crore. Looks good.
Mm-hmm.
And profit after tax, PAT, also up 10% year on year at 445 crore. Again, sounds positive.
Right. But then you dig just one layer deeper.
And you hit this massive number. Total spends grew 31% year on year. 31%.
And that's the core question, isn't it? If spends are rocketing up 31%, why didn't the profit, the PAT, grow way faster than just 10%?
Precisely. Something's eating into that growth. That's what we need to unpack for you.
Okay, let's start with that velocity then. Segment 1, the growth in spends and portfolio size. This is all about the activity.
Yeah, the core business metrics look, well, aggressive. Spends, as we said, jumped 31% YoY. Reached 107,063 crore in Q2 FY26.
That's up from around, 82,000 crore the year before. That kind of acceleration is key. It's really significant.
Definitely. Now look at the card base itself. Cards in force, or CIF, grew 10% YoY.
Okay, 10%. So reaching 2.15 crore cards, still strong growth.
Absolutely. And new accounts opened were steady. 936,000 new accounts in the quarter. Pretty much flat year on year, actually.
Right, steady additions and receivables, the money owed.
That grew 8% YoY, hitting just under euro 60,000 crore.
Okay, so let's pause there. Cards up 10%, new accounts kind of steady, receivables up 8%, but spending up 31%.
Exactly. That's the crucial point for you, the listener. The growth in spending is way outpacing the growth in the actual number of cards or customers.
Which implies existing customers are spending a lot more. They're getting much more activity out of the cards already in people's wallets.
They're successfully turning existing cardholders into power users. Increasing frequency, increasing transaction value. Dramatically so.
And this ties into their market position, right? The sources confirm they're holding strong.
Yep. According to the RBI data available up to August 2025, they're still number 2 for cards in force. Market share actually ticked up slightly to 19.0%.
Okay. And number 3 for spends.
Number 3 for spends, yeah, but their share there grew more significantly, from 15.7% to 17.0%. They're gaining ground through sheer volume.
So they're consolidating their position, basically by getting people to use their cards more and more, which brings us back to the cost.
Right. That incredible spending growth has to be funded somehow. So let's shift to segment 2, revenue mix and cost pressures. Let's look at the P&L.
Okay, diving into the income statement. Total income up 13% YoY, we said that. But the mix is interesting.
Also,
well, interest income, that's what they earn from people carrying balances, paying interest that increased by 9% YoY, reached about 2,490 crore.
Okay, 9%. But what about the other side, fees and commissions?
That's the non-interest income. And that grew much faster, up 16% YoY, hitting 2,471 crore, almost catching up to interest income.
Ah, so the fee income, driven by transactions, is growing nearly twice as fast as the interest income from lending.
Exactly. It reinforces that high-velocity spending story. More transactions mean more merchant discount fees, more processing fees. They're leaning more on activity than revolving debt for growth right now.
Makes sense. Now, costs. This is where it gets really interesting. Finance costs.
Yeah, the cost of their borrowing. You'd expect it to go up with growth, but
it actually declined, down 4% year over year to 760 crore.
How did they manage that?
Smart treasury management, basically. Their cost of funds, or COF, dropped quite a bit. It was 7.1% in Q1, fell to 6.4% in Q2. That's a decent saving.
Okay, wait. So they saved money on interest costs. A 4% drop is significant, but Patty only grew 10%. So where did that saving go?
It got swallowed whole, and then some, by the next line item. Operating costs.
Ah, and that's where the pressure is.
Big time. Total operating costs jumped sharply, up 24% year over year, 24%, totaling 2,484 crore.
Wow, 24% increase. That's huge. Do the sources say what drove that?
They do, quite explicitly. It was driven by, and I quote, higher spend-based costs towards campaign and offers and higher corporate passback.
Okay, let's break that down. Campaigns and offers, that sounds like marketing, rewards, trying to get people to spend.
Exactly. Cashbacks, points, special deals. and corporate passback.
That's essentially the cost sharing with their co-brand partners, right? Like airlines, retailers, they
Yeah,
pass back some of the revenue generated.
precisely. It's the direct cost of buying that spectacular 31% spending growth. They're investing heavily, paying partners, giving rewards to make their card the top choice.
So they're sacrificing immediate margin for market share and, well, future dominance, hopefully. High price to pay in a competitive market.
It really shows when you look at earnings before credit costs, EBCC. That's basically profit before setting aside money for potential bad loans.
Right, a measure of core operating performance.
Even with those finance cost savings, EBCC only grew 8% year over year. That 24% jump in operating costs really put a lid on it, shows the strain of this growth strategy.
Which leads us perfectly into the next crucial area, asset quality, risk management, and capital strength. Because when you grow lending that fast...
You have to ask, is it good growth? Is the risk contained? That's segment 3.
Absolutely the essential question. And the news here is, well, a bit mixed, but it does show management being proactive.
Okay, give us the numbers. Gross non-performing assets, GNPA. That's the total bad loans before provisions.
That actually improved. It decreased to 2.85% this quarter, down from 3.27% a year ago. So a 43 basis point reduction.
That's positive. Suggests better loan origination or maybe effective collection efforts?
Could be. But then you look at net non-performing assets, NPA, that's after provisions.
Yeah.
That actually ticked up slightly year over year. It's at 1.29% now compared to 1.19% previously, a 10 basis point increase.
So a slight deterioration after accounting for provisions? And what about the total amount set aside? Impairment losses.
Impairment losses and bad debts expense increased by 7% year over year, hit almost 1,300 crore.
Which you'd expect to rise somewhat just because the overall loan book is bigger, right?
Yes, partially. But what's really notable here, and highlighted in the sources, is management's prudence. They made 2 extra specific provisions this quarter.
Oh, on top of the usual provisioning.
Exactly. First, a festive provision of about 28 crore. This was on the standard good loan book. Based on historical data showing spending patterns during festival seasons can sometimes lead to slightly higher stress later. They're provisioning before the potential risk materializes.
That's quite forward-looking, acknowledging cyclical risk ahead of time. What was the second one?
A 31 crore provision for a pending issue related to stamp duty from an old amalgamation scheme back in 2019, basically cleaning up a potential historical liability.
So tidying up the past while proactively bracing for the future seems prudent.
Very much so. And despite these costs and provisions, their capital position looks really strong.
Yeah, the capital adequacy ratio, CRAR, how's that looking?
Very comfortable. Stood at 22.5%. The minimum required is 15%, so they had a huge buffer. Tier I capital was 17.5%, also well above the minimum.
So they absolutely have the financial muscle to absorb these growth costs and manage the risks.
And the rating agencies agree. Both CRISIL and iShares reaffirmed their top ratings. Triple long-term, A1 plus short-term, that's a strong vote of confidence.
Okay, solid foundations then. Let's move to segment 4, strategic portfolio insights and new offerings. This is where we see what people are doing with all that spending.
Right, getting into the consumer behavior. The portfolio mix itself tells a story.
You mean like who's paying off their bill versus carrying a balance?
Exactly. Transactors, the ones who pay in full each month, their share of the receivables actually increased, up 4% year over year to account for 44% of the total.
Interesting. So more people paying in full, which again points to maybe higher income customers being attracted.
And reinforces that fee income reliance we talked about. These transactors don't pay interest, but they generate transaction fees. Revolvers carrying a balance were 34%, and EMI loans were 22%.
Got it. And how active are these cards?
The retail spend active rate was high 62.5% for the first half of the fiscal year. People are definitely using the cards they have.
Now, here's a detail I found fascinating in the presentation, the spending category breakdown.
Ah, yes. Where is the money actually going?
The absolute explosion was in what they call Category 3. Travel agents, hotels, airlines, railways, entertainment, and restaurants.
Okay, basically travel and dining. What was the growth there?
Get this, 125% year-over-year growth in that category. 125%.
Wow. Okay, that's massive. That single category must be driving a huge chunk of the overall 31% spend growth.
Has to be. It's pure discretionary spending. You could call it post-pandemic revenge travel and leisure spending, maybe. And SBI Card is riding that wave perfectly.
Absolutely. That gives fantastic color to the numbers. It's not just more spending, it's more high-value discretionary spending.
And they're also pushing on the digital front, right? UPI.
Yes. UPI spends on their RuPay cards grew 16% just quarter over quarter, so sequential growth there is strong.
And the data showed differences between cities.
Yeah, Tier 1 cities drove the bulk 79% of those UPI spends. And the average spend per account was higher in Tier 1, around 18,500 compared to about 14,700 in Tier 2 and beyond.
So the big metros are leading on digital velocity, but there's clearly room to grow usage in smaller cities too.
Definitely. And this focus on high-growth areas like travel, dining, and digital ties right into their new product launches.
Right, they launched 3 big co-brand cards this quarter.
Very targeted launches. There was the Phone T SBI card, clearly aimed at digital payments, offering cashback on Phone P app spends.
Then the Flipkart SBI card focused on e-commerce, obviously, with cashback there.
And the Indigo SBI card directly targeting that booming travel segment, offering rewards redeemable on Indigo flights.
Each one designed to capture high-volume users in precisely those sectors, showing massive growth. It's very strategic.
And operationally, they mentioned streamlining onboarding too, using that centralized K-Locker eKYC for over 2.5 lakh customers, making it easier to sign up.
Okay, so let's try and wrap this up. What's the overall picture for you, the listener?
I think the summary is this. SBI Card is very successfully tapping into this huge surge in discretionary spending, especially travel and dining. They're growing fast.
It's costing them.
Yes, they're maintaining excellent capital strength, which is crucial, but they are absorbing much higher operating costs, mainly from those aggressive reward programs and partnerships needed to fuel the growth. And they're being prudent by setting aside extra provisions for potential risks.
So the core takeaway is the 31% growth is real, it's impressive, but don't ignore the 24% jump in operating costs needed to achieve it. It's a conscious trade-off.
They're clearly choosing market expansion and capturing that spending wave now, even if it squeezes margins in the short term. Betting that market position will pay off long term.
Which leaves us with a final thought, maybe a provocative question for you to consider.
Go for it.
Given that they made those extra provisions based on future anticipated festive spending risks,
That forward-looking festive provision.
and knowing that strong credit growth sometimes precedes asset quality issues down the line,
It often does, historically.
should the focus for the next quarter be more on pushing even harder to maintain that incredible 31% spending growth velocity? Or should it shift slightly towards ensuring that slight uptick we saw in net NPAs, even though it was only 10 basis points, doesn't become a worrying trend?
That's the balancing act, isn't it? Growth versus risk management. Where does the priority lie going forward, especially if the macro environment changes? Something definitely worth watching in their next set of results.
Exactly. That's the tension to keep an eye on. And that wraps up our deep dive into SBI Cards Q2 FY26 results.
We'll be back soon with more analysis. Thanks for tuning in.